Hello and welcome to the third in our series of the Monetary Club podcasts. My name is John Petley. I'm the senior researcher at the Institute of the International Monetary Research, and my guest today is Professor Steve Hanke, a long-time friend of the Institute, someone whose CV would take an awful long time were I to read it out in full. So just to give you a brief summary, he's had a long connection with the Johns Hopkins University, founder and co-director of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise. He has also recently been appointed a distinguished senior scholar at the Mises Institute, and he certainly had a very big global reach as well. Welcome anyway to we're going to be starting off today, and really our focus will be on the US economy. Now, you for quite some time have been warning about an impending recession, and in the first quarter of 2025, you noted that the US economy showed some signs of weakness. You've pointed out that the broad money growth is below your golden growth ratio. Do you see this as a harbinger of things to come, or do you actually think there's going to be an improvement from the second quarter onwards?
I think it is a harbinger of things to come, John. And before we start, I've been reading you for years. It's great to be with you today.
Well, thank you, Steve.
In any case, yes, I think things will continue to show weakness and slow down in the United States, and probably end up tipping into recession later this year. But let me set the table just a little bit before we jump into this. If you look at the from the start of the pandemic, that's February of 2020, in the United States, when the pandemic hit, of course, the Fed goosed the money supply, and at its peak, actually, measured by M2, the money supply was growing at over 18% per year. That's the highest year-over-year rate that has ever occurred since the Fed was founded in 1913. And what happened then? Well, the first one to actually indicate that we were going to have a real inflation problem was Tim Congdon. That was shortly thereafter, John Greenwood and I, again using the quantity theory of money, which Congdon was using, said, yes, we're going to have a bout of inflation. And John and I said that inflation would probably reach as high as 9% per annum. Well, it reached 9.1%. So we got that right. And we also got another thing right with the huge surge in the money supply. Greenwood and I said that the asset prices would go up, and they did. Land prices went up, housing prices went up, the stock market boomed, all asset prices soared. So we got that right. So we got the first 2 points in nominal GDP, the real growth and the inflation right. And then after inflation peaked out, the Fed threw everything in reverse and started contracting the money supply. And Greenwood and I, again, using the quantity theory of money, indicated that inflation would start backing off and coming down. Well, we got that right. But the one thing we didn't get right is what you started with your lead question, and that is the fourth point in this cycle. Remember, we had nominal GDP, real growth, and inflation. We got that on the upside. On the downside, we got inflation, but the real growth, we thought, John and I thought that we'd have a recession last year. So we way ahead of the thing. And of course, the critics of the quantity theory of money and monetarism just hammer us over this. Oh, Hanke, you and Greenwood said we were going to have a recession. We haven't had a recession. And I say, well, there are 4 data points in this cycle. We got 3 out of 4 right. No one's even come close to that. And they go on about the fact that we keep saying there's going to be a recession, and there hasn't been one. So we have been wrong. We didn't get the timing right on that. I think we eventually will be proven correct because there have only been 4 significant contractions in the money supply in the United States since the Fed was founded in 1913, and those were all followed by recessions. So I think we're going to end up with at least a big slowdown. The reason, looking back, you ask, well, why did you get the timing wrong? And when we got the timing wrong, because of actually 6 factors. The monetary overhang from the pandemic was much bigger than we thought, and it was much slower to drain off than we thought. Number 2, there was a huge savings overhang from the pandemic. Number 3, there was a huge fiscal largesse, and with the fiscal deficit running, way over 6% of GDP. And the interest rate effect, the 4th factor, the interest rate increase that did occur was muted because of remortgaging that had happened during the pandemic and refinancing. And 5, there was a huge wealth effect because, as I said, the increase in the money supply caused a surge in asset prices and an enormous wealth effect. So the balance sheets, in short, putting it all this together, the 6th item, balance sheets are pretty strong in the United States. And when that happens, usually the recessions might not be quite around the corner as would otherwise be the case if you had weak balance sheets. So that's the long answer to your short question.
Yes, I in many ways, what happened in 2020 was typical in terms of the surge in broad money growth and then the sudden contraction. But there were certain, as you say, rather atypical features of it, which has meant this, although your predictions have been pretty close, the timing, at least for the recession, didn't work out quite as you'd expected. But you're still very much saying it's still on the cards, just a bit later than we initially predicted.
Yeah, I think the quantity theory of money tells us the bottom line is it's baked in the cake.
Yeah.
If you get a big contraction in the money supply, you're going to get a contraction in nominal GDP. The real component and the inflation component will go down. So to put this thing into context for people listening, let's talk about the upside, the inflation part of things. I've looked in world history, there's never been a significant inflation. And that I would define as an inflation of 4% per annum plus a duration of at least 2 years, lasting at least 2 years, that hasn't been preceded by a significant increase in the money supply. I mean, you change the money supply significantly, and nominal GDP is going to change significantly with a lag, of course. Now, the trick is, and this gets into your first question, these long and variable lags are a little bit tricky. And the one we had with the pandemic was extremely tricky. It was very difficult to get the timing right on the recession. And Greenwood and I didn't get it right. We were way too early, basically.
Yeah, but it's still on its way. As is another problem. I mean, you have been following Tim's comments on the US budget deficit, which seems to be growing and growing, and he regards this as being unsustainable as it stands at the moment. What are your thoughts on that? Would you agree with that assessment?
Well, I think Congdon is ahead of everybody on this one too. I agree with him completely. Number one is that it's in the long term, it's a big problem, and that is the deficits and the accumulation of debt. And the reason that deficits are a problem, fundamentally, if you have a significant deficit, it really throws up a lying price to taxpayers. It says that the government spending is actually less expensive than it actually really is. If you have a balanced budget, the price would be right. the government's spending 100 and the taxes are equal to 100. The lying price comes into the picture with the government spending being 100 and taxes being only 90. And so the taxpayers, in a way, think they're getting a bargain. And that means that politically, they're always in the game with lobbyists, special interest groups. Everybody wants more from the government because they're not being charged full freight. So that's a long-term structural kind of thing. The short-term thing is another factor, and that comes in that we can put this in Keynesian terms with the Keynesian multipliers, actually. And remember that if you have a significant fiscal deficit, you can throw out the Keynesian multipliers that are contained in the textbooks. They're all positive. So if the fiscal deficit goes up and you have a positive Keynesian fiscal multiplier, the deficit gooses the economy. It stimulates the economy. But if the deficit is significant and large and it's perceived to be unsustainable, those Keynesian multipliers are actually negative. So let's go back to Great Britain, 1981, Thatcher. The Thatcher squeeze in 1981. What happened? Well, Thatcher raised the budget. She thought confidence in the government was zero, and they had to restore confidence to get the thing on the rails. So Thatcher did a squeeze. She increased taxes and cut government spending and reduced the fiscal deficit. And you had 364 economists, virtually every economist in Great Britain, except people like
Tim.
Tim, there were a few outliers. Congdon was one of them.
Yes, absolutely.
The other big one, by the way, was my close friend and great colleague at the Johns Hopkins University, Sir Alan Walters, who was Thatcher's economic guru at 10 Downing Street at the time. He was the one who designed the thing. And the reason for that, he'd done econometric work, and he knew that if confidence was shattered because of very large fiscal deficits, that the Keynesian multipliers would be negative. He'd done econometric work on this. So he was the architect of the thing. And Thatcher went along with it. And the 364 wrote their letter to the Times and said that they were going to have a Great Depression in Britain because of the fiscal squeeze, because they were assuming that the multipliers were positive. So what happened? The austerity restored confidence and stimulated the economy. Sterling boomed, the economy boomed right away. So what you have in the United States right now is a situation where I think the Keynesian multipliers are negative. We've had these huge fiscal deficits, and all the economists say, oh, this is going to stimulate the economy. No, I think it's going to be a drag on the economy. The way to stimulate an economy that's running deficits like we have in the United States right now is to do a Thatcher squeeze, to impose austerity. That would actually goose the economy and put stability back in and confidence. So that's a short-term kind of problem that we face. Deficits have a long-term problem because of post-lying prices in the fiscal realm. If they're large, there's a short-term problem, and that's the negative fiscal multipliers. Now, as far as my role in this thing, I'm very active because I'm a member of the Federal Fiscal Sustainability Foundation's board of directors. And our conclusion is that you can't fix this deficit problem and debt problem in the United States with statutory changes. They're like a Band-Aid. They always get torn off. You have to change the US Constitution and put a fiscal brake in. You've got to do what the Swiss did in 2001. They had a referendum. Over 90% of the Swiss voted in favor of a constitutional change and a Swiss debt brake. And the Swiss debt brake basically says that you have to balance the budget in Switzerland and that the growth in government spending can't exceed the rate of growth in real GDP. So the size of the government in Switzerland never can expand relative to the private sector.
That sounds a good move, and I think we need someone with your particular insights to give some advice to our current chancellor, the way things are looking in this country. I think we're going to be heading for a repeat of 1981, the way things are looking.
Great Britain is in such trouble. I can't tell you how pessimistic I am, because it's a warfare and welfare state. You couldn't even fill a barracks with troops, let alone finance the thing.
No, it's a very big worry, and I think this side of the Atlantic, there's plenty of us that feel every bit as concerned as you do. Anyway, just going back to the money supply, one thing that is interesting as I've read your various bulletins is that you have focused very much on the official M2 data from the Fed. Now, as we both know, the Fed used to publish the M3 data, but stopped doing, I believe it was in 2006. Now, Tim Congdon has continued to try and work out the M3, either initially by using John Williams' shadow stats figures, and more recently, since we don't seem to have been able to get hold of them, he's been calculating them himself using the Fed's H8 data, which includes long-term deposits, and of course the money market mutual funds. Now, sometimes in his analysis using the M3, it hasn't pointed to quite such a negative picture, admittedly still a reasonably negative picture of the outlook for the US economy as you have using M2.
If you're a monetarist and you embrace the quantity theory of money, of course, the most important thing to be able to do is measure money.
Yeah.
What's money? So I sympathize with Tim wanting a broader measure. Number one, you should have the broadest possible measure possible. So that's one issue. So I use M2 because it is the official number. That's officially what's presented. So if I don't use that, you run the risk of having people start quibbling with you. Oh, why are you using Tim Congdon or Shadow Stats M3? I mean, that's not even the official number. So you get in a whole nother set of arguments and issues and controversies about M2 versus M3, because M3, it really is an official number. I wanted to avoid that. The M2 versus M3, those are simple sum measures for the money supply. You take all the components, and as you said, the M3 that Tim is using has long-term deposits and money market accounts added in to what M2 has in it. They're a simple sum. You just add the components together. The best measure, and Tim and I don't agree on this, and even John Greenwood and I don't agree on this. I'm a divisia. The best measure for money is divisia. And divisia isn't a simple sum. It weights the components of the money supply given the monetary features that are contained in the components. And I prefer divisia M4, actually, even a broader measure than Tim has. Now, the last component of M4 is actually Treasury T-bills. And if the interest rate is low, of course, the weight that is placed on those is relatively high. If the interest rate is high and the opportunity cost of converting to treasuries into cash for transactions purposes is high, of course, the weight is less. Now, here's where you can get into real big differences between simple sum measurements and divisia. Go back to 1980s, 1980, 81. Volcker was the chairman of the Fed. And when you get very high interest rates, you can get a big divergence between simple sum measures and divisia. So that's why I prefer always divisia. I mean, theoretically, it is the best way to go. Most times at low interest rates, it doesn't make much difference, really. Divisia versus simple sum. And by the way, if you look at my new book with Matt Sekerke, Making Money Work, that book, chapter 7, we go through the divisia thing inside and out. And I might add, for those who really want to understand divisia, William A. Barnett, Bill Barnett, he is the world's expert on this topic.
Now, you've led me on to nicely on to the last point I wanted to discuss with you. Two new books that you have co-authored. One of them being a book on capital interest and weighting, controversies and puzzles and new additions to capital theory, and also Making Money Work, how to rewrite the rules of our financial system. Would you like to tell me a bit more about these two books?
Well, yes, I'd be happy to. The first one, Capital Interest and Weighting, is a book on capital theory that I co-authored with the late great polymath Leland Yeager. And looking at both of these books, you have to think, what is macroeconomics to me? Well, macroeconomics, there are only two aspects to it. One is monetary theory, and the other is capital theory. If you put those two things together, that's macroeconomics. Now, what we have with capital theory, this first book with Yeager, we're in a zone that most economists don't know anything about anymore. I mean, they don't even study it, and it's not even on the agenda in PhD programs. But capital theory is notorious for being perhaps the most controversial area of economics because it holds the key to the explanation of profits. After all, capital is at the center of the inquiry into the laws of production and distribution in any capitalist economy. So Yeager and I have delved into all the various puzzles in capital theory, which the high priests of economic theory have most of them dealt with at one time or another. And weighting is in the title. Now, what is weighting? Weighting is just deferring consumption and saving, and the payment for that weighting is the interest rate. And that we contend is a factor of production. And to think about it, if you take weighting out of the production function, production goes down. Now, the second topic, of course, is monetary economics. All the theoretical macroeconomic models are post-Keynesian models that don't even include money. So what Matt Sekerke and I are doing in Making Money Work, we're putting the quantity theory of money back in the picture. We're putting commercial banks back at the center of the financial system, because most broad money is actually produced by what? Not by central banks, but by commercial banks. So monetary policy, very important aspects of monetary policy, which, by the way, Tim Congdon is very well aware of, deal with regulations concerning commercial banks. That's why Congdon and Greenwood and I focus and pay a lot of attention to Basel requirements, capital asset ratios, because changes in the capital asset ratios and the regulations dealing with those affect the capacity and the inclination of commercial banks to actually produce broad money. And also, neutrality of money should be very important. The effects of the money supply in various sectors of the economy and on groups in the economy should be as neutral as possible. We not only want price stability and economic stability, we want neutrality. And to give you an idea of neutrality, the last run-up in the United States in the money supply was very non-neutral. In January of 2020, millionaires' wealth as a percent of GDP was 14.1%, John. And now it's 21.7%. Now, why is that? It was because we had a huge increase in the money supply. And what happened? That caused asset prices to explode. Well, who owns all the assets? The rich people do. And they became very rich. The billionaires made out like bandits because of the non-neutral effects of this huge increase in money supply.
I found it interesting that you mentioned the neutrality of money, because that's obviously one of the things that's been used by critics of say, the QE programs over here. Basically, that they're not neutral. The people that benefit from the QE programs are people who've already got a fair amount of assets anyway.
Oh, this is a huge thing. The central banks, by not embracing the quantity theory of money, the central banks have been the biggest distorters of income distribution in the history of man. Forget all these welfare programs and everything. Yeah, they do have an effect on income distribution. But the big effect is the non-neutrality of money created by monetary policies that governments and central banks, bank regulators, and so forth impose. This income inequality that we have, this is a problem. And it's a big political problem that the left jumps on. But the left doesn't understand. It comes from monetary policy, which of course the left is clueless about. They embrace things like modern monetary theory. It's the most non-neutral bunch of rubbish that you could possibly dream up.
Well, it's so good that you've been able to do this and produce books of real heavyweight quality that I think will be a very welcome contrast from what is widely taught in universities in my country as well as yours, and of course swallowed by central bankers and a lot of senior figures in both countries as well. And obviously we've seen, as we've been discussing, the results of that, the downturn that you're prophesying for the next few months, and of course we're heading in a pretty bad way as well. And I hope that just as we want to make the case for monetarism over here in the institute, that what you've done, your work at the university and these books, manages to make a positive effect on the debate in the USA. So thank you once again.
Well, John, thank you. It's been a pleasure to be with you.